let's talk a little bit more about the NCI, right? The non-controlling interest. So questions that have the parent company purchase 100%, and this is something we mentioned before, this is nothing new, but really drilling down on it because this is a concept, again, you might not be as familiar with, and I want to make sure you are. So if the company purchases 100% ownership of the subsidiary, that's going to be much more simple than a question where if the parent purchases, let's say 70%, because the 30% not purchased by the parent is not controlled, and as such is the NCI. They're going to be using the equity method then. If this is the 30%, this portion of the subsidiary's equity net assets is attributed to non-controlling shareholders and reported at fair value on the parent's consolidated balance sheet separate from parent's equity. This may also include the NCI's interest in goodwill in the subsidiary. Again, it might sound weird that you're including the part of the company you don't own on your own balance sheet. It might. That's fine, but that's what we do. Yeah, this is my job also to point out, right? Like things that don't inherently like make sense. I'm not gonna say it doesn't make sense, but it might be like, what the heck is going on, Nick? Like, why are we doing this? And that's just the rule. The reasons behind it, don't worry about it. This is just something that we are going to include on our balance sheet in our equity section. Balance sheet. So NCI is reported in consolidated equity. The consolidated balance sheet includes all the subsidiaries' assets and liabilities, however, not its equity, as we mentioned. You'll see a bunch of questions where say, oh, what's the total equity here? And it shows the parent and subsidiaries information. Well, you just X out all of the subsidiaries' equity and you include just the equity of the parent. When an NCI exists, the parent lists the NCI's share of the net assets on its consolidated balance sheet in the equity section, but separate from the parent's equity. At the acquisition date, we calculate the NCI with a simple calculation. If the fair value of the subsidiary is $100,000 and the parent does not own 30% of it, the NCI is $300,000. I'm going to show you a super common calculation you'll have to do. Now, it might not give us the fair value of the subsidiary. It might say, we bought $900,000 of a company and we got 90% of it. So we purchased $900,000, like we spent $900,000 for 90% of it. Now, how do you determine the fair value of the subsidiary and as such the NCI? Well, these are pretty clean numbers, so you might be able to just guess it here. But basically, we're going to do 900,000. Let's say they're not clean numbers. $900,000 divided by 90%, and that's going to get you to $1 million, which means that if you subtract out your portion, NCI equals $100,000. Again, I know this was nice, clean numbers I just showed you, but they might not give you very clean numbers, right? It could give you, something gross, right? It could give you for, 78%, right? They could do that. I mean, they probably won't give you something that gross, but this is the process. That's to determine the fair value of the subsidiary. And then obviously from there, you can calculate your NCI. You can take the percentage and say that, what percentage do we not own? Well, in this case, that's 22% times the fair value. A couple ways to calculate the NCI, because you will have questions that have you calculate the NCI. Again, NCI, just what you are not owning. That's the part that you do not own. And if you remember the equity method, this is the equity method, right? So equity method, we use equity method for the NCI. NCI has a beginning, let's say, of $100,000. Now, let's say the subsidiary makes $100,000 in net income. And so subsidiary, let's say the NCI is 20%, we own 80. So NCI is 20% means they get $20,000 of net income. Okay, so under the equity method, we would add that $20,000 to the NCI's balance, right? The investment in account, right? This is the flip side of what we're seeing. This is the equity method. Now let's say subsidiary pays $200,000. Now let's do less because that wouldn't make sense. Let's say they pay $50,000 in dividends times 20. Where's the percent key right there? Where's the percent? There it is. So if you're going to pay 20%, right, then that's going to be $10,000 of NCI reduction. So minus $10,000. Your new NCI balance here is going to be your $10,000. One way I like to sort of remember this is, and I'm not sure if this is how it works in the real world. I'm not. There are a lot of things I've worked on in experience, right? Audit, tax, some advisory, some month-end close, bookkeeping, lots of good stuff. I'm not sure if this is how it actually works, but in theory, in my mind, since you can control the subsidiary, I would think that as the parent, you could kind of force the subsidiary out by constantly make them paying dividends and reducing the subsidiary's balance in them. Now, I don't know if that's how it works, and I'm sure there are legal restrictions against that, but that's kind of how I think of this, right? Because let's say I'm the parent and I own 80% and I want to own 100%. Well, I could just keep having, I control the subsidiary. I can kind of tell them what to do. I tell the subsidiary to keep paying out crazy amounts of dividends. And as such, that would constantly reduce let's say they pay out another dividend. This time it equates to $100,000. That would mean that the NCI's balance is now 10,000, right? You just keep getting them down almost to zero. Again, I don't know if that's how it actually works in the real world. I could talk about many different other topics on many things. Someone feel free to reach out. Tell me if that's not how that would work. I'm sure there's a lot of legal reasons you couldn't do it, but that's a great way. I kind of remember this whole, again, relatively different concept of adding in subsidiaries net income and subtracting out subsidiaries dividends. It's a relatively different sort of process. On the income statement, right? Now let's get to our income statement. So we discussed the consolidated balance sheet, but what about the consolidated income statement? Oh, forget about it. Let's skip it now. The consolidated income statement includes 100% of the subsidiary's revenues and expenses after the acquisition date. The consolidated income statement reports net income attributable to the NCI, separate from the net income attributable to the parent. Again, if you own 80%, you'll have your 80% of the net income to the parent, 20% to the NCI. Net income attributable to the NCI is computed by multiplying the total subsidiary net income by the NCI's ownership percentage. If there's a loss, it's still attributed to the NCI and might report a negative balance. So right here, you might have a negative NCI balance. This is kind of what I was talking about before. I don't know if that forces the NCI out. I'm not really sure how that works, but hey, again, if you do, feel free to let me know. But not important for our exam. That's why I'm not going over it. Well, this is nothing crazy, right? So subsidiaries net income, like before, it's $100,000. If you own 20% of it, that's $20,000 in net income you get. It's negative balance. It's negative $20,000, right? Nothing too crazy. You just get the percentage of the net income or net loss that you own of the subsidiary. Consolidated financial statements. What about the statement of comprehensive income, right? We can't forget about that good old one. So the statement of comprehensive income should show the following separately: consolidated comprehensive income attributable to both the NCI and the parent. Don't worry about this one as much. Focus on the balance sheet and income statement. But what this one is basically saying is you just like the others, display it separately. Display the parent's information and the NCI's information separately. But you consolidate between the parent and subsidiary. The NCI is over here. Parent subsidiary is consolidated over here. I mean, you really can see why it's much easier when you own 100% of the company. You don't have to deal with this NCI stuff. Okay, changes in equity. So NCI is reported in the statement of changes in equity as a part of the equity of the consolidated group. So again, the whole point of this, NCI is constantly reported everywhere. This consolidated statement should display a reconciliation between the beginning and ending carrying amounts of total equity, equity attributable to the parent, and equity attributable to the NCI. Not as important as the balance sheet income statement. We're just running through them all, right, and how it's displayed and what you need to see.